You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. It's been an absolute barnstormer since the start of the year with a story on stock on market, interest rates and price growth. And to our surprise, we're still under 3,000 properties in the market by the end of February. Who would have thought we'd still be in this situation with transactions running just below our 5-year average at the moment in the 700s every week, and that's just an outcome of the limited stock on market in the first place. We're taking a third to a quarter of the stock on market off the market every single week right now, and with nearly every one of those transactions comes a mortgage. And so the banks are very busy right now, which means the mortgage brokers are very busy right now, which means we have to have a conversation with the most awarded mortgage broker in WA. It's Sam Carello. Sam, thanks for coming in again, mate.
Thanks for having me, Trent.
I thought it would be a good opportunity a couple of months in now, after we've come back from holidays, started writing a few loans, started settling a few loans over the last couple of months to get a gauge as to what the feel on the ground. And brokers really are the coalface. You've got real estate agents, brokers and settlement agents. These guys see it all. And so I thought it would be a good time to get some nuanced feedback from you about what's happening right now and how that maybe is a little different from where it was 4 months ago when we last chatted about the market. First one, who would have thought interest rates would be tipping up a couple of weeks ago, eh?
Yeah, I think up until late November, the prediction was the economists were coming out saying there was going to be 2, potentially 3 rate cuts in 2026, and then all of a sudden a bit of data came out, and within a week we saw the banks' fixed rates jump, typically 0.5%, and then that narrative around rates coming down changed pretty quickly, and we obviously got the rate rise at the start of this month.
First one, did all the banks just pass 25 points on? Did any go less or more on their standard loan product?
Pretty much all 25 points, and they all announced pretty much the same day. And so with that, they announced that the rates were going up, so the 0.25, and then typically, I think the RBA met first week in Feb, and all the banks are applying those increases between the 13th and 20th of Feb. So they give you a week or two before they do increase it, but they announced on the day, majority of them, that they were increasing, and there was even a little mistake in, I think, ME Banks, I don't know if you saw it, ME Banks, messaging where they hadn't properly proofread the release, and they must have just reused the template from when rates went down, because they put in there, we're happy to say we're passing on the 4.25% rate increase.
Really?
Yeah, so that got a bit of social media coverage. I don't know if that marketing person's still in a job or maybe a slap across the wrist.
Well,
but
it shows that it's humans behind these logos at the end of the day, isn't it?
That's it. But yeah, they definitely all did pass on the 0.25, and yes, those have been passed on, and that's on the variable side.
Let's talk fixed, though, because you mentioned that, and we haven't spoken about fixed rates for 4 years, 3 years at least. No one's taken one out, let's be honest. Are you having conversations now with, obviously, a little bit of the nerves of how high can this go? That's when they really try and get you on a fixed rate. It's the insurance policy that you're paying for, really, to have some peace of mind. That's the rationale. That's the sell behind a fixed rate, isn't it? Are you having conversations? Are you writing fixed loans?
Yeah, so conversations, definitely. So when we catch up with a client, we'll present obviously the variable, and then we'll just note what the fixed rates are. The fixed rates moved, like I said, early December. All the banks moved.
Down or up?
Up. So circa 0.5%, and that's always a good indication that they believe that rates are going to go up. Obviously, previous to that, during COVID, you had your 2% fixed rates, so everyone was on those, and then since then, it's just been an upward trend in the market, so no one really fixed things. It did escalate quite quickly. Then it's proposed to be a downward trend, so again, people were staying on the variable just to make sure, or to try and capture that decrease in rates, which they did receive in 2025 with the rate cuts we had. But right now, the fixed rates, they have jumped, so when you compare it to a variable, the variable rate is still sharper than the fixed by a little bit. So for example, a variable owner-occupier P&I rate with a 20% deposit, so an 80% LVR, loan-to-value ratio that is, they're starting at circa 5.54%. A 2-year fixed rate, as an example, is 5.69, is best in market. So
not huge. It means the banks aren't that confident it's going to stay up for a long time or keep going up, but they're pricing in a little bit of a premium just for that surety that you might be looking for.
Yeah, and I think the indicator is when you look at 5-year rates. So that same 5-year rate, so an 80% land principal and interest, best in market's 5.89. So it's not a huge jump from where we are on the variable.
It's 125 basis point move. So what it means is, in my head at least, is that they don't really know where it's going to be in 5 years, but they still want to charge a bit of a premium if you want that confidence.
Yeah, and I think, again, it depends. Each individual client's situation is different. If the 5-year forecast rate is 589 and you've got a 554 on the variable, as we've discussed before, those fixed rates don't give you the offset ability. They don't give you the ability to pay more than typically $5,000 to $10,000 a year, depending on the bank. So a lot of clients, and if you were to break that fixed rate, there are costs. So a lot of clients are looking at the moment and going, you know what, we'll probably take the punt on the variable. It just suits our needs a little bit better. And again, typically in Australia, we're not like the US where you have your 30-year fixed rate once you sign up for your mortgage. Majority of mortgage holders do take a variable.
They like to ride the wave, don't they?
They do. Offset. I've had a couple of clients living or over from the US and also UK. And the facility of an offset isn't available to them. So for them, they're like, this is crazy. But then at the same time, they're like, what do you mean my interest rate can change each month?
Yeah, I know family in Europe, they'll take split rates. And we haven't spoken about that much at all in the industry for a long time. Not many people engineering their loans for a portion of fixed and a portion of variable. But over there, most people will split their rates. They'll have a small amount of variable, probably for some level of a redraw or ability to pay down faster if they want. But most of it will still be a 3 or a 5 year at least, and often a 10-year fixed as well.
Yeah, and I think that's probably what's going to come into the market now moving forward. When you do have those 2-year or 3-year fixed rates similar to the variable, I guess it just mitigates a bit of risk. You've hit the nail on the head where we just need to make sure we give the client the ability to offset and the ability to pay back more as well. That's a calculation that we do where we run through the numbers, see how much you can have left over post-purchase, for example. All right, we need at least that much variable so we can offset it. And then we also look at, in terms of repayments and budgets, how much extra do you think you can pay over and above what your minimum required repayment is? And say that's $2,000 a month as an example, and you signed up for a 2-year fixed rate, you'd want to take at least $48,000 to $50,000 as a variable portion, because based on your plan, you're going to have that to be able to go in to the offset. So what we would do is we go, cool, how much savings have you got left over once the transaction's gone through, and say that's $50,000. And then we look at your cash flows and your budgets, and if you believe you can save, say, $2,000 a month, we go, all right, we need to give you at least another $48,000. And then we probably give them a stretch target. So we might then give them an extra 50 on top, just to make sure that if you do get better at saving, or you get the promotion at work or the pay rise, you do have the ability to put that money somewhere if you choose to.
When you think about the relationship you're having with your clients right now, where in 2025, I think most brokers were writing pre-approvals more than they were getting formals, given the lack of opportunity for their clients to be buying. Has that started to relax a little bit, given the fact that stock on market hasn't really improved that much? But has there been any change to the dynamic of your client base specifically getting the offer accepted any quicker than maybe a year ago? What's the dynamic there, or do you still have a stack of people who want to buy but just can't?
Yeah, our clients have had some really good success recently. I think off air I mentioned to you, it's probably been the busiest start to the year that I've had in 12, 13 years, just the amount of inquiry, which has been good to see. So in terms of success with offers, what we found is typically clients, you go in on a property, you're probably going to be one of 6 to 8 as a minimum in terms of genuine offers. You probably had 40 or 50 groups through that home open. So what our clients are doing, we're getting them pre-approved, and then typically, depending on their situation, we're just trying to get them in a position where the flexibility around the settlement is most critical. So what we'll do is we'll get a pre-approval, and then the clients will put an offer in subject to finance 5 days. We've say a 21-day settlement if that's what the sellers want, or we can extend that up to 90 days for settlement from finance approval.
We see a lot of sellers who are using their settlement time to buy them time to go and buy something, because that's just as hard for them as it is for the people buying their property. What happens in that situation where the seller goes, look, I'm happy to accept your offer, happy to accept your 5-day finance or cash, whatever your risk profile was, but I want 6 months.
Yep.
And the buyer, your client, comes back to you and says, Sam, what do we do here? My formal approval is only valid for 90 days.
So when my clients put in offers on those properties, if the seller wants a longer settlement, you can do on or before 90 days, typically, and then that means that approval that they get is still valid. We settle the property, and then what I'm seeing in there is like rent back clauses. So it might be rent back at a discounted rate for up to 3 to 6 months, and that just takes a bit of the pressure off the seller, because they go, worst case scenario, we've got 90 days till we settle.
Get our money.
Yep, get our money, and then if we need to, we can rent and stay in this place for another 3 to 6 months at a fair rate. And obviously that's got to suit my buyer as well, but that's one way where we've had a bit of success.
And you can achieve that with a bridging loan.
Correct, yeah. Bridging loan.
First home buyers kind of stay at mum's house for a little bit.
Yeah, first home buyers stay at mum's house. You can get that with a bridging loan. If you're buying it as an investment, there's no issues there. Yeah, so it all works.
Thanks, Mum.
At the moment, I'm probably doing 1 a week, bridging loans, sometimes 2.
How many were you doing 2 years ago?
Probably 2 or 3 a year. Probably more than 2 or 3 a year, but the inquiry around the bridging, the ability to be able to borrow 100% plus fees, move into that new home, and then have 6 to 12 months, depending on the lender, some lenders even up to 2 years, to sell your place. It's what you need. It means you're removing that subject to sale clause. It's just subject to finance, or if they're confident, clients are removing that finance clause.
Is it costly?
Again, like I do the numbers and like you look at it, yes, you're paying the circa anywhere, depending on the lender, 7 to 9% on the interest rate. Some lenders have obviously your higher application fees. Someone like a St. George Westpac, it's $600. Someone like a Latrobe or a Bridget, they charge a percentage of the loan amount, so that can get costly. So it just depends on the client's situation and what they're looking to do. For me, typically, if you can do the bridging, put a property under offer, know your settlement date, and then you can get yours ready and on the market. A lot of my clients are only bridging for 2 weeks, so it's not an expensive exercise because you only pay the interest for the period that you hold both properties. Also gives you 2 weeks to move, so it's not like you've got the core, you've got the moving truck in the driveway and you've got to get from one to the other. If that one there is someone's home and there's 3 or 4 properties lined up, they might not be able to move to the next day.
All the time in the settlement business where you've got these chains of settlements, 4 or 5 properties long.
Yeah.
And if one of them doesn't come through, everyone else along the chain gets stuffed around and having to call their moving guy and say, nah, I've got to sleep here tonight still.
Yeah, and that's the thing. So the bridging loan, especially if like everyone's got equity at the moment, it feels, especially if you bought 5 years ago. So bridging loans, yeah, really good. Downsizers are using them. St. George or Westpac product, they've got a no end debt bridging loan. So if it's literally,
what does that mean?
So there's not going to be any end debt. So for example, say they might have a property worth $3 million and they're buying a downsizer for $2 million. No debt on that $3 million property. They're retired, so they can't.
But they haven't got the cash yet because they haven't settled the sale yet.
Yeah, so what we do is the bank take both securities. The bank go, cool, we're going to hold both properties, so that's $5 million worth of security. We'll forward you your $2 million plus your fees, so 2.1. And then some lenders will capitalise that interest for up to 12 months. So say it's, ideally you don't want to hold it for 12 months, but say you did, you got interest on top. What they do is when they sell that $3 million property, the bank take back their $2.1 million plus interest, and then the proceeds come to the client.
And that should really help with, again, the cash flow side. If you're retired, and if you don't have that $12,000 a month maybe for the $2 million, that, again, could be another hurdle for you. You think, all the other boxes are ticked. Oh, I have to pay a mortgage of $12,000 a month. I don't have that in the bank. I'm a pensioner.
Yeah, and it's interesting. So guys, again, I'm probably harping on about St. George and Westpac, but I believe they have the best product. They will capitalise that interest to the loan as long as you got the equity, and they put their buffers in place. They shade 15% off the value of your sale property, and that's their risk buffer as well as enables you to capitalise the interest. Other lenders who do it, and they might offer a slightly cheaper rate like a CBA or ANZ, where rather than paying, say, 8.9%, you're paying 7.2%. But you have to find the repayments during that period. So whether that's you borrow it or have cash there.
Horses for courses, eh? The point is there's a few products there that help people when they're moving.
Yeah, and that gives you that mobility to be able to go from your owner-occ into a new owner-occ. It frees up the market a little bit. You're not having to do a subject to sale offer. You're not having to move on the day. And for me, if you look at the cost of a double move, when you're thinking if you couldn't do that bridging and just pay the interest, you're paying movers twice, you need to store your furniture somewhere. It's just a bit of a headache.
Instead of mentioning your clients going cash, which we've seen around the traps all the time in the last couple of years. You mentioned this 5-day finance thing. I don't think there are that many brokers who could achieve that and with confidence. How is that possible? Is it with specific banks? Is it because you're a top broker that gets stuff done a lot quicker through the banks and you get priority? Most of the time, your brokers will say 14, 21 days. How are you getting it done in 5?
Yeah, so clients, if they've got the risk profile, we explain what a cash offer is. So some clients will do a cash offer because, like you said, there is a lot out there, but that's only once they're fully assessed pre-approval. All we're waiting on is the property value, and you probably want to make sure you're not borrowing 80% or to your max. You want to make sure there's a bit of fat in there. With the 5 days, typically we like to get all our clients pre-approved. We're quite fortunate where we do have platinum status with a number of banks, and we get to do 2-day turnarounds within probably 8 or 9 of our lenders.
Because all you're doing there really is a desktop valuation and here's the contract.
Correct, yeah, because everything else is done. So desktop val, which again typically in this market's coming in, here's the contract, this is the new structure. So with the pre-approval, again, conversation that we have with the client is, initial conversations always, all right, where do you want to buy? What sort of budget are you looking at? What ideally, if I could give you anything, what would you want? And then we obviously get them to fill out a living expense sheet. And then we review all that and go, cool, based on the information, you said you want to be at 1.5. We think, and it's 2 ways, we think you're at 1.2, so let's go through the numbers for 1.2. Or, yeah, we can get you 1.5. We can even get you up to maybe 1.6 or 1.7. Now, ultimately, you have to be comfortable with those repayments. But what we do in our meeting is, if they're saying 1.5, I might prepare for a 1.6 purchase, a 1.5 purchase, and a 1.4. And then what we do is we go through the numbers there, and then the client has a look at it. We get the pre-approval in place for the maximum that they're comfortable with. So even if the bank are going to lend them 1.7, if they go, after our meeting, hey Sam, thanks for showing us that, but 1.5 with the repayments, that's where we're comfortable, that's what we lodge the pre-approval for. And then on their search, they know anywhere up to 1.5, they're good to go, subject to evaluation. Hey, great, if you buy for 1.45, all we do is just drop that, which on pre-approvals, drop in the value, nice and easy.
Not a problem.
Yeah, if you had to go up, then potentially the bank are going to ask for new pay slips, new applications. In that initial discussion, we just make sure that the client's really comfortable with what their maximum is, and then we work back from there.
Let's try and help the kids for a few minutes if we can. How's that first home buyer 5% scheme been going over the last 4 months? Obviously, we had the big push, big rush in October, November, December. Has that already started to taper based on prices just rocketing above that? Or has it been pumping through? Are you seeing a lot of it? I know it's not your specialty, first home buyers, but you'll be getting a lot of friends and younger brothers and all that still coming through. What's happening on the ground there?
Yeah, so that first quarter that was released October to December, inquiry levels were crazy. A lot of inquiry on it, people wanting to get on it. Since then, for me anyway, like you said, I don't do a heap of first home buyers, but since then the inquiries probably come off a bit, and I'm finding some of those first home buyers that were in there, if they were around that 750, they've just been priced out, to be honest, which is unfortunate. I think, yeah, the government obviously had big plans for it, but all it's done that I can see is just drive prices to an 850 minimum cap, which is really tough. And if you got a single first home buyer, you've got to be earning some pretty good money to be able to actually afford it. What's
the conversations with those clients then? Is it a case of, I'm really sorry, I'm not your financial advisor, but it looks like to me the only thing you can do is compromise on your preferences here and just find a property that is in your price range, because it ain't going up, and with the interest rate rise 4 weeks ago, it just got harder?
Yeah, that's exactly right. So same thing, we have that conversation, where do you want to be? And then I'll do the numbers, and if the numbers say, yeah, you wanted to be at 850 but we're at 700, we'll go through that and have that conversation, explain to them why they are at that 700. If there's credit cards we can close, or that help debt facility or alternative assessment, we'll have a look into that, see if we can get them any more borrowing capacity. But ultimately, they've got to be comfortable paying it back too. And I think new generation of first home buyers, there have been a few conversations where it's, we can afford 700, but when we look at the repayments, they go, repayment wise, my max is $2,500 a month, so they only want to borrow 500.
Is that based on their lifestyle is just more frivolous or exuberant than the banks are assessing them at, and they don't want to, and they don't want their lifestyle to be limited by just a mortgage? Or is it that they're more risk averse?
I think it's a bit of column A and a bit of column B. So I think Yeah, lifestyle, I think, like we said, they do that living expense example. We have a look at the bank statements. Like, there's all the data there. So if they declare they're spending $1,000 a month and it's $3,000, we have that conversation with them because we can see it.
But normally the indexes the banks use are, I would say, fairly conservative. For example, when I would look at most of the applications that I would process back in the day, most of them genuinely spent less than what the index was covering. And so I'd be surprised if people were suggesting that they need more savings, they need more play money than what the index is allowing in the first place.
Yeah, I think living expenses, like everyone talks about the cost of living and the HEM, or what the banks use as their measure, does get updated monthly. I've seen it definitely creep up in the last 12 months. Like we said, if they declare under, we have that conversation. The bank are going to use the HEM anyway. But yeah, a lot of them are saying, Sam, I think based on my lifestyle and what's coming in, I don't want to spend more than X. And sometimes it drops where they can buy, but I respect that. Last thing you want to do is take a mortgage and then not be able to go out down the pub with your mates or enjoy life, or just be tied to it, being a job you hate. The mortgage is 30 years, hopefully less, use of an offset and things like that. There's no point taking a mortgage to get in the market if, you're going to be miserable.
To be honest, it sounds like a lot of us when we were younger, it was what we had to do for a few years, and then we got a promotion, or then we got a pay rise, and life got a little easier. But yeah, look, everyone has to make sacrifices, and I agree with you 100%. But at the same time, if it came down to having to sacrifice on a beer with the mates versus I just got the home I wanted versus somewhere 20 k's further out, I know the choice I'd be making.
Yeah, but yeah, like I said, probably a slightly different generation to me and you.
Isn't that sad to say?
Yeah, I know. Greys are coming through, but and that's fine, and you just got to respect that. Everyone's different.
Before we head off, I wanted to quickly just get a roundup from you on where rates are at. You mentioned that the owner-occupier P&I rate is sitting in the mid-5s, but what are the rest of the rates looking like right now?
So variable owner-occupier principal and interest, 80% lend, so we'll do all these based on a 20% deposit. And that's about 554 to 565. Investment interest only on a variable, starting at circa 6%, just over, through to 6.15. And then you have your fixed rate. So your owner-occupier to your fixed rate with the 20% deposit, starting at 5.69. That 5-year rate we have from 5.89. So there's not a huge spread in that. And then investment interest only, as an example, a 2-year interest only rate, you're looking at sort of 584, and that 5-year interest only rate's circa 619 to start.
What's the split of investors to home buyers right now?
I'm seeing, and again, it's probably my client base, I'd say upgraders is probably my biggest cohort at the moment. There are definitely investors, and we're looking to do, if it's an investor, it's typically a refinance. We cash out and then buy an investment property. The conversation around buying properties for children has probably become more relevant in the last 6 months and dominant.
Is that through a parental guarantee or a cash out to give them money? What are they normally doing?
Or just buying their kids a property.
Yeah, wow.
Okay. And the kids,
thanks for coming.
Yeah, and the kids aren't necessarily, we're talking they're 6, 8, 10. So the parents are looking at it going, hang on, the market's pretty hot at the moment. I don't see how my kid in 10, 15 years' time is going to be able to afford to get a property, 20 years' time. Don't really want them living at home with me the whole time. So what we'll do is we'll buy an investment property now, have someone rent it, and then that's something that our children can move into down the track. I think that's been probably a lot more of a common conversation in the last 6 months than I've had previously. In terms of parental help, definitely parental help out there too, whether that's typically a cash gift, just because servicing is usually maxed. So it's usually a cash gift to help them get through with the deposit. Seeing a few guarantors, but yeah, that cash gift of, hey, I've saved 50,000, but mum's going to give me 100, 200, whatever it may be to help out, helps. And then that obviously increases the purchasing power as well. And it's, like we said, it's pretty hot out there. Every property that's on the market, there's typically 6 to 8 offers. I've got examples of offers from 900, that property selling for above $1.50.
And I guess that means that you've got to be prepared for that, because obviously your client's not prepared for it. Most of the time, I assume, when they're saying, we're planning on $1 million, you're probably doing your numbers at 1.2 just to cover off early days.
Yeah, and that's, as part of the process is we'll present them, we'll get them to figure out where they roughly want to be, and then we'll always present either side if they can afford it, and then the client ultimately makes the call as to how much they want to be pre-approved for.
But I'd reckon that you'd these days just by habit be having to cover the upside cost of it, given every single person I've seen call me, come through my door, has had to go on that journey themselves, thinking, yeah, we're starting at 1 mil, and it'll probably take 4 to 6 months if they're proactive, and they'll eventually end up with a property that is a slight compromise to what they were after, and it was 20 to 30% more expensive than they thought they were going to have to pay for it.
Yeah, like you said, we're the coalface. So if a client's putting an offer on, typically I get a call and I say, yeah, give me a call if you're looking to put an offer on, we can chat through. I think probably the last couple months, the advice I've given people is, all right, you know your numbers. If you're comfortable at, say, $1.50, is there any point going in $1.20 because you've been told it's going to go for over $1 million? If you saw that on realestate.com in 3 months and you missed out by $20,000, would you be sad or would you be okay? And so the advice there is just go your best offer first forward, so the agent knows you're serious.
No regrets.
No regrets. If you don't get it for that, you don't get it for that. You weren't going to go any higher anyway. If you do get it for that, you're comfortable paying that. So great.
It feels like a conversation we've had for 4 years now. It's just more and more critical than ever these days.
And it's not, I think, long gone are the days of, we think it's going to go for $1.50, we're going to start at $9.80. Like, there's just too many offers coming in.
Yeah.
The agent goes, I can't negotiate with all of these, and a lot of agents are just taking the top 3 offers.
They don't have the time to do any more, let's be honest. And often they're trying to get this done in the space of a weekend rather than stretching it out 2 or 3 weeks, making their job harder than it needs to be. And so you got to get in quick, you got to get in hard and be confident. And the only way you can be confident is with the top brokers in Perth. Sammy, thanks so much for coming in, mate. Appreciate your time. As always, what an update it's been, and we'll speak to you again soon.
Thanks, Trent. Cheers.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!